All right, well, a lot of news in the bond market this week, y'all. We're going to get right into it. I'm going to try and keep this one short, but it's likely to be a longer video. Mortgage News Daily. We're going to get right into the numbers. We are sitting in their national survey for a 30-year fixed rate conforming loan, 6.76% today. That's up from a week ago. We were at 6.69. 30 days ago, 6.71. That doesn't sound like a whole lot of movement, y'all, but there was a lot of volatility over that 30-day period. In fact, when you look at it, our 30-day low was on the 13th of August, 6.69% in that national average. 30-day high was on the 23rd of July, 6.85. So we've seen a lot of volatility, at least us as lenders, we view that as a lot of volatility. We initially got some news, y'all, that gave us some reprieve in the middle of the month. That's why we saw those low rates back on the 13th. That was in response to a weaker than expected employment and jobs number, better than expected CPI and PPI reports. So when you see inflation seemingly coming under control and a weakening job market, well, those are the two areas where the Fed is most focused with their monetary policy. So that should take some of the wind out of the sails of the possibility of a cut. And we certainly saw that. In fact, when you look at the CME FedWatch tool, there was a 30 days ago, y'all, there was a 65% chance that the Fed was going to raise rates on or before the meeting on September 16th, the upcoming Fed meeting. There is now only a 35% chance that the Fed is going to raise rates on or before that meeting. Again, that's the 9/16 meeting. So we've basically cut in half the possibility of a Fed hike going into the upcoming Fed meeting on September 16th. That's the good news portion of today's video. Let's talk a bit, though, about what rattled the markets yesterday. We saw an initial very favorable response in the bond market to the Treasury announcing that they were going to be doubling or more than doubling the amount of long-term debt they're going to be purchasing back. So the Treasury, y'all, differentiates itself from the Fed quite a bit. When the Fed buys long-term debt, that's called quantitative easing. They literally just send a wire to buy these on the Chicago Board of Trade, long-term treasuries and mortgage-backed securities, and they don't even bother to print the money to buy them. They just send a wire in order to buy them. Now, that is inflationary. It creates currency where currency didn't previously exist. And economics 101 is when there's more currency chasing the same amount of goods, it's inflationary, y'all. And it's one of the reasons that we got inflation, because we had a massive amount of quantitative easing as a response to COVID and the economic slowdown that COVID created back in 2020, 2021. Now, I think folks are all aware that that has occurred. When the Treasury repurchases a long-term debt, they can't print money for that purchase, y'all. They have to sell stuff in order to buy stuff. So what do they sell? Well, they issue shorter-term debt, 6-month T-bills, 1-year T-bills. They issue shorter-term debt in order to get the money to buy the longer-term debt, repurchase it back. That has the net effect of, y'all, of to the tune of at least $4 billion a month now. We're effectively refinancing the national debt from longer-term maturities, which are more stable, to shorter-term maturities, which are far more volatile. The last time this occurred, y'all, was in May of 2024 by the Biden administration, and I was very critical of it back then because I considered it nakedly political going into a national election. Well, y'all, we're headed into another national election, and we can't take out of the calculus here that politics are weighing into the decision to want to see lower rates. Now, there are some good reasons why the Treasury would want to bolster support for long-term maturities by repurchasing them other than just politics. I'm just saying you can't escape the fact that we got an election in 2.5 months in this country, and a big one at that. All right. What are the other reasons that the Treasury may have done this? I may have said Fed earlier. I mean the Treasury. Well, you have Japan, y'all, and this is a big national story that's not getting much news. Japan's currency is collapsing. The yen is just in free fall. And in order to bolster support for the yen, the Japanese government is unwinding their position in U.S. treasuries so that they can purchase the yen to bolster the value of their own currency. Y'all, when they unwind their position in U.S. long-term treasuries, they put a lot of those instruments on the market. And keep in mind, supply and demand is economics 101. When you flood the market with supply, you're going to bring prices down and yields up. The way to think of it is this: if there's a lot of product out there and you can't get somebody to buy it, all you can do is lower the price. And if it's an investment instrument, you got to pay the yield that an investor is going to receive on it, or increase the yield rather. Those increasing yields are our rates. That happens on a global scale, y'all. So these markets don't care where the demand comes from. So if the Treasury purchases them and gets some of that additional supply off the marketplace, it helps bring prices higher and bring yields lower, thereby supporting that long end of the yield curve. So is that a good reason for the Treasury to do it? Well, they may not have a choice, y'all. They may just see that as not having a choice. Additionally, you've got big corporations now like Google, like Amazon, that are spending tens of billions of dollars on data center development, y'all. They are having to float bonds in order to pay for those capital investments. And those corporate bonds are paying nearly 7% for a 30-year bond from Google. So corporate issuance, y'all, is presenting a lot of an uncommonly high degree of competition for U.S. Treasuries. A lot of folks are looking at those and saying, you know what? I'm as comfortable with Google as I am the U.S. government right now, and they're paying me a much higher yield, so I'm going to buy that instead. So you see a lot of investments going in that direction. So you combine all of those things: the political pressure, the competition from corporate bonds, the need to bolster collapsing money supplies around the world in order that we have continued folks to trade with. And you get a picture that is scary, it's unstable, and it's concerning, but it's still something, frankly, for nerds like me, that's kind of fascinating to follow. And whatever the results of it are, I'm going to be here to report it, y'all. So I'm going to continue to do that as we move forward. Here's the bottom line: if you had a loan that was not locked today, I'd probably lock it, because I am a little concerned about this news, particularly the news in Iran, that we have turned the corner into economic warfare. That y'all is only done for one reason: you've got to make 90 million Iranians angry enough over their economic circumstance to do something about their seemingly intractable government. That's a very long-term commitment, y'all. That's regime change. That's a bit of a change in focus that the administration has been pursuing in Iran. And if that's where we're headed now, then this may be a much more longer-term commitment there. Markets are digesting that, in addition to everything I've just described around what the Treasury is doing. So it's a very mixed bag, with a lot of spinning plates and a lot of things up in the air. I am all about trying to digest it as much as possible, y'all, and present it to y'all in the most understandable way possible that my feeble brain will allow. So in any event, hope this has been helpful for you and for your clients. Stay blessed, stay safe. We'll talk more about it next week.